5 top trends to follow in private markets right now. Very, very quick introduction. The panel consists of Johnny El-Hashem, Jim Garman, Joanna Rochescaf, and Alexandre Prigent, who will moderate it. Thank you very much. Have a good start to the day.
Good morning, everyone. Thank you for joining us. So I'm Alexandra Prigent. I'm the managing partner of Excellency, which is a strategic advisory firm for investor relations and capital markets. And today I'm very happy to be moderating this panel. I'm joined by Joanna Scarf, by Jim Garman and Johnny El-Hashem. And before we start, I'll spend just very few minutes introducing our speakers because it's a very diverse and expert panel. So I'm very much looking forward to hearing your views. So Joanna Rochescaf, you're the head of private equity at Neuberger Berman, which is about 90 billion asset under management for third parties, mostly in funds, secondaries, and co-investments. So today you'll probably talk with a very active LP hat, I suppose. And I would like to add that you're the chair of the LP committee of BVCA, which is the Reference Private Equity Association in England. Johnny, you are the CEO of Edmond de Rothschild Private Equity, which manages 3.5 billion in private equity across 15 specialist strategies with a very strong historical focus on sustainability, and I'm sure you're going to talk about this. And finally, Jim Garman, thank you for joining us. Jim is co-head of Goldman Sachs Asset Management, particularly focusing on alternative assets and with a very long track record investing in real estate. In terms of number, the alternative assets for Goldman Sachs Asset Management is about 430 plus billion across varied strategies, obviously the whole spectrum. So thank you so much, very diverse and interesting panel. I'm going to start with the first theme that I think is kind of right there in front of us, and it's probably democratization, retailization of investment, of private markets, and that goes without saying. It includes obviously digitalization, new dynamics in terms of inflows, but also some, challenges in terms of maybe transparency, liquidity. So I think it will be very interesting to have your views on that. Joanna, if you want to start.
Thank you. Good morning, everyone. Pleasure to be here. Yes, we're going to be discussing trends in private markets, and honestly, there were lots of trends. We kind of picked 4 or 5 to discuss today. One of them being this democratization of private equity and the extension of this asset class beyond the typical universe of institutional investors. So historically, this asset class has been largely destined to the institutional investor group. And let's look at the reasons behind that. So to enumerate a few, typically to invest in private markets, you have high investment minimums. We're thinking 5 million or above. High eligibility requirements. You have to be a qualified purchaser or a professional investor in many jurisdictions in order to invest in private markets. Long lockup periods. Fund structures are multi-years, tend being quite common. And there's a lot of uncertainty around cash flows. It takes time to deploy, it takes a lot of time, and it's quite unpredictable to realize. So there's this illiquidity issue that's acted as a real barrier to retail investors. And then on top of that, there's also a lot of admin complexity, both on the subscription process. I mean, we've all seen the hundreds of pages that in an LPA and subdoc package, as well as the obligations that you have once you make a private markets investment in terms of cash flow management and then tax reporting, of course. So we have seen a lot of managers try to address these issues, and also regulators have tried to flex the rules to allow semi-professional investors and semi-affluent investors to be able to invest in private markets. And what we have seen in terms of offerings development are offerings that frankly address some of these pain points, like having shorter investment periods and shorter fund durations, typically more of a couple of vintage year constructs. Having reduced admin complexity, allowing you to invest electronically and giving you simpler tax forms, not K1s, but 1099s and similar forms. And this has obviously enabled less sophisticated, less professional investors to come into the asset class. But importantly, I really want to stress this point. for this to work, the structure should be adapted to address the pain points, but the offering, the fundamental offering content should not be watered down. What do I mean? That hopefully managers are giving retail investors access to the same high quality product they're offering institutional investors. So this is super important. And then you mentioned two key points. Obviously, transparency and fee efficiency, they continue to be at the top of the criticisms in the institutional channel. So it's important, and those have not really been addressed either at the institutional level necessarily or at the retail level, but it's important to keep those points focused, because obviously if there's a perception that you're overcharging retail, I think the issues are going to be quite significant on the regulatory side. We've also seen firms use new technologies like blockchain to allow tokenization of their offerings. There's a few notable in the market where a portion of the offerings have been tokenized and offered to retail investors at minimums that can be 20K, 25K, but certainly materially lower minimums that allow more investors to participate. And I'll stop here in terms of the democratization points.
Do you want to say something? I know this is something we've discussed, in groups.
I think Joanna hit all the complexities of this. Look, I think this is a inevitable trend that's going to happen. I think the numbers I looked at, there are $10 trillion of private market assets. Only about 5% of those go to these types of investors at the moment. Most managers, or certainly the larger managers, are talking about increasing that to 20 or 30% of the next offerings. To me, the key thing is two things Joanna said. One is getting the technology right, so that it's easy to access for this type of investor, and then the quality of the products and the performance. This is, I think, we're at the very early stages of this evolution. As an industry, we have to get it right. If we have performance issues, hiccups, then the reputational damage to the sort of the private market industry will, be irreparable. So patience and getting it right, I think, is more important than speed here.
If I may, I would love to add two things. I fully agree with all of has been said. I don't want to repeat the elements. However, to your point about offering the same content to the large client and to the small client, we should get in mind as well the fact that a retail investor needs to be diversified. So it's important as well that GPs who has single strategy, in my humble opinion, cannot play into this field. However, platform with multiple strategies can package and commingle solution, which allows to the diversification, which is key. On the transparency of fees, we have to admit that's something very easy to deal with. We need to report two things separately and differently. The performance of the fund, provided that we offset the cost impact on the small tickets, and the distribution cost. Because honestly as well, let's say it, distributors are milking it out because that's a product that they can sell because the clients cannot have access to. So we have to split how much the distributor is charging from what the GP is doing and the fees that comes to the play. Last but not least, and this is key as well in my humble opinion, for retail investors not to get the reputational damage you're mentioning, and this is very important for the decades of efforts that we all deployed to bring this industry where it is today, it is a must to avoid going a direct B2C channel and to privilege a B2B2C channel. Many private banks need content. Many third-party independent financial advisors need content. So it's much easier to trust private bankers, third-party asset managers, for them to advise better their client on how to build an allocation. And let's aim collectively to avoid the direct B2C route, because this requires a know-how that, in my humble opinion, with all the due respect for the retail investors, I don't have.
Thank you very much for your insights. And I'm going to warn you, if we try and cover the 5 topics we have highlighted, we're going to have to be shorter. So the second topic we wanted to discuss with you today was the impact of the sell down in listed markets, the impact of that sell down on private markets, and whether that creates any shift any reshaping of portfolio construction, asset allocation? And I guess related to that, have you started to see any shift from typical equity, obviously private equity, to credit to real assets? So that's I mean, maybe Jim, I don't know if you want to take this one. I guess
Sure,
your
thank you.
profile.
Look, I think it's this is sort of a live issue right now. And what's interesting about it is in previous cycles, when there was an economic downturn, equity portfolios would sell off, interest rates would come down, fixed income portfolios would appreciate. And so there was sort of balance in portfolios. This cycle we're going through now, we're coming off such a low point in the interest rate cycle that obviously equity markets have sold off. I think the S&P is down 20% this year. But we've also seen fixed income portfolios sell off as well, similar amounts. And so the denominator, the pie, has shrunk. And just so mathematically, if somebody had a typical sort of equity bond allocation, then 10% in private markets, that's probably now 13%. If it was 20%, it's probably now 25% or 20%. So you've seen this just shift in private market allocations as a result of the sell-off in public markets. What does that mean? I think we're going to see three things. Number one, clients, investors are going to revisit their whole asset allocation and ask themselves the question, actually, can I tolerate a higher allocation to private markets, or do I need to adjust? And then I think we're going to see really a lot of activity in the secondaries market, because I think we'll see clients adjust their overall private markets allocations by accessing the secondaries market quite actively. And then I think with a changing economic environment, I think we're going to see clients also adjust their portfolios to get more allocations to things like private credit, which is obviously a safer, shorter duration, high yielding asset in a rising rate environment. And then with inflation, we're certainly seeing a lot more appetite for certain parts of infrastructure and certain parts of real estate as well. So I think what all that means, we have a secondaries business at Goldman as the others do, and I think that part of our activities or our business is just going to be really active over the next several years. Remember, this is really a this year phenomenon, and I think we're just at the beginning of all this adjustment.
I mean, Johnny, you run a platform as well.
So the question that we should ask ourselves is to Jim's point about the fact that, at the same time, equity markets going down and fixed income is not anymore a safe haven when things are turning sour. So why? Let's ask ourselves the question, why we've ended up here? Because we've been investing wrongly, because we've been fueling speculation, and we didn't act as a conviction-driven, and we didn't do the jobs that we financiers should do. And it would be a huge mistake, and I'm calling for action on behalf of all of you here, for the LPs as well, to assume the fact that private market is a long-term play. And we should stick with the allocation that is granted to GPs like us to do the right things, to build on new foundations, to solve the problems that we've been trained into. And there is rooms in private market, in private equity, to build solutions that are inflation, provide a hedge for inflation, provide this diversification. And the dry powder we have at our hand is a fantastic opportunity to do things differently. The only thing we should avoid is continue to change into and going into more volatile things just for the sake of taking short-term returns. This short-term approach is destroying us over the long term. If the fundamentals are not standing there anymore, it's because of the bad practices we had in the past. That's it.
Joanna, maybe before you comment on that trend, which is a major one, I think adding to that, the shift in liquidity and reacting to those comments about short-term, long-term, also takes us to the third trend that we have identified that we thought was interesting to share with you today, which is the fact that it's very likely that GPs will have or will want to hold on to their assets longer, because indeed the shift in liquidity will require, but will also impose that some GPs find solutions to be able to create value for the longer term. I don't know if you want to react to that.
I'll pick on that one and move us along, otherwise we'll never cover any new topic. So this trend that we would like to discuss next would be the desire for companies to stay private longer. So we've seen it in venture capital, where very successful tech or new media companies have taken longer to hit the IPO market and to become public vis-a-vis what Microsoft and Google did back in the day. But we've also seen in the buyout space, GPs trying to keep some of their assets longer and longer, because not necessarily does a life of a company, a good company, I mean, hopefully it's not finite and certainly shouldn't fit the term of a fund, which is typically 10 years. So a good company should be long-lasting. And many private equity firms have realized, look, if they buy a company from a founder, the opportunity to create value initially probably is more professionalizing the asset, institutionalizing it, then perhaps is developing new products, expanding geographic boundaries, and so on and so forth. And many have decided or looked to extend their ownership of those assets. How have people done that? They've done it by potentially selling a partial stake, creating some liquidity, but keeping it into the same fund. And when it starts approaching the term of the fund, they've generally done it two ways more frequently, especially in the last 4 or so years. Proposing cross-fund transactions, whereby a successor fund buys an asset from an older fund. And they've also done it using the GP-led market, launching these so-called continuation funds. So these are, frankly, new developments. We've definitely seen a lot of growth in these technologies. And to put it into context, last year, more than half of the volume in secondary markets was driven by these so-called GP-led transactions. I mean, so far so good, because it's another exit route, frankly, for investors. But there are a few points to note, so I'm just going to flag a few to note. One, what is the motivation for doing a cross-fund transaction is extremely important. And ultimately, you should be doing something in the best interest of the LPs, because you have a fiduciary duty to the LPs. I've seen a bit of stuff that I preferred not to have seen.
Say it, the conflict of interest should not fuel this. Say it.
Exactly. Before doing something, I mean, as a GP, I always ask, really understand what is your honest motivation for doing this, and make sure it's in the best interest of the LPs. And if you do that, then it actually, I think the problems start sorting themselves easily. Related to that, conflict management, valuation setting, super important. I mean, there's an inherent conflict. You're a buyer and a seller. You need to somehow be able to set the price on an arm's length basis, in my view, with a competent third party, such that that valuation question is addressed. Other things to consider, process for allowing your existing investors to make a decision. They need to have information, and they need to have time to consider the information and make an appropriate decision. Other things to consider I would say, is on what terms are you going to offer this opportunity to your existing investors? I mean, are you gonna charge them 3 times what they were paying before to keep what they actually had before? Is not gonna look very good. So a lot of groups, including ILPA in the United States, have advocated for status quo options. That is almost fiction, because it's not gonna be a status quo if you're moving into a different fund. But as close as possible to the old terms will definitely create less friction amongst the various LPs. So some ideas for thought out there. And again, I'm taking the investor perspective on this point.
I mean, just to add one, it also ties back to the start of the conversation about the ability of retail investors to access private markets. As more and more companies stay private for longer and the number of public companies comes down, obviously the universe of investable companies, if you can only access public markets, is shrinking. And so it all ties together. You know, we believe that more and more companies will stay private for longer and longer for the reasons Joanna described. And so making those companies available to retail investors is important.
Yeah, but let's learn as well from our colleagues in the real estate field. They faced it and they built core plus, or opportunistic. I think that the fund industry is a fantastic tool with the governance and the fund documentation to align and preserve the interest. Let's not use gimmicks to find solutions to problems. If it is in the best interest of everyone, let's do it. If not, let's build evergreen structures that holds assets for the long run. I think this industry is at a tipping point. Let's remain very focused and disciplined and not go into routes that might create damage on the reputation that we're doing.
Thank you very much. I'm going to move to the fourth strand, which is about the GP landscape. So I'd love to hear your views on what I call the barbellization of the GP landscape. So by that, this very ugly word, I mean the fact that you can see two big trends. One with GPs building, extremely broad platforms, getting bigger and bigger, and covering the whole spectrum of alternative strategies. And at the same time, and I see that a lot of LPs are also very interested in that solution, having specialist, ultra specialized platforms or strategies which are much smaller in size, but much, I would say, probably more targeted in the way they think about their investment strategy. And I think the panel today is a very interesting panel for that purpose. So Johnny, you're definitely one of those specialized platforms. Do you want to give your views? And obviously, I think everyone wants to hear the rest of the panelists' views. It's a major trend.
Friends, please join us in Summit Room 1 for the International Summit. Thank you.
This is the most important one.
Right,
So if
please
you want to
don't-
join, feel free.
Please don't leave. Please don't leave. Give us 10 more minutes.
You might wonder how come a 3.5 billion platform is sitting next to a sum of 500 billion here. But the reality is that, yes, this is a mega trend now. It's a big trend. All of the GPs outside understood that the fundamentals have changed, and they're trying to go more the skills route and the specialization, if I may use this word. Having said that, there is many problems related to that. Small GPs cannot exist anymore. Regulation problems. We don't need to give back, to insist more on that. You all know it here in the audience. Second element, if you're really specialized to create value by tackling a real problem, you cannot be a 3 or 4 or 5 billion mega fund. That's impossible. You cannot defend the DNA of the action you're trying to achieve on a very specific skills and matter, because that's boots on the ground. It requires a lot of men and women. Fees are shrinking. So how to deal with the matter? The best approach is to have a platform that can centralize many of the functions that are in a way mutualizable across the board, and give the capacity and give the time, the autonomy, the alignment of interest required for real specialists to manage real specialized strategies. And then by doing so, you can get the best out of two worlds. Build a diverse content, remain very disciplined to what you can deploy and how much you can really create value with based on the capacity of the men and women executing, and try to as well cope with all of the evolution of the industry on a platform approach.
Jim, you're probably the representative in my story of the other side of the barbell, and then I'd love to hear, the
Look,
LP expert.
I think there's obviously, I think there's room for both ends of the barbell. I think in any industry, you have large-scale players, and then you have true deep experts who are very, very, very good, world-class at certain things. We run a scale platform, and I think some of the benefits I see of that are kind of the network effects of having a very large, deeply resourced platform that reaches all parts of the world, all asset classes. One of the things we do a lot in our business, we run businesses in real estate, which is my area, private equity, private credit, infrastructure, impact investing, and some other things. And we really work on getting the teams across those businesses to really connect together, because some of the, I sit on top of all of that, and the themes we see around things like technology, demographics, sustainability, they cut across all those strategies. And so if you can get insights and know-how into each business, then that should lead to improved performance. So I think there are benefits of scale, not just absolute size, but this sort of connectivity and networking effect.
I'll just make a quick point on this. I very much agree. I mean, the era of making money buying low, selling high, or just putting leverage and doing the financial engineering game is over. So when we look at the value creation in private markets, in theory, should be largely driven by earnings appreciation. In fairness, in the last, few years, we've had a massive bump from positive multiple arbitrage. That was not underwritten in the base cases by and large, but frankly, in a declining interest rate environment, we've all benefit from public and private market equity multiple expansion that led to astronomical returns in private markets. I mean, we're looking at 40% plus IRRs in the last couple of vintages. That is obviously not something to be expected, but was there. But one cannot assume that's going to be there in the future. We're in a rising rate environment. If anything, I mean, we should have the expectation that valuation multiples will compress, that there will be a negative arbitrage between entry and exit, and that the value creation needs, and more than ever, needs to come from revenue and earnings growth. To do that, you need specialization, you need a lot of functional capabilities that I've seen private equity firms create. They introduce data science analysis when they're making investments. They introduced functional operating partners that they're specialized in procurement, in HR, in financing, and the list goes on in order to create that extra value creation. Now, this has a cost. And to make up for that cost, you need a bit more scale. So we've seen some of the more successful private equity firms, frankly, increase in scale. And there's been clearly a concentration of capital with these groups that have those resources. In fact, for us, it's creating a little bit of a problem because those groups tend to be actually very successful, and many have been very successful. But the fund sizes have grown a bit too large. And at some point, you don't want to just have exposure to large caps. So very much keen to see perhaps not very subscale smaller funds, but perhaps the mid-market adapting to the new reality so that investors like ourselves can have a bit more diversified exposure across like company sizes.
Yeah, and you can deal with the holding ratio problem by being exposed to diversified players who can commingle solution for you. Happy to discuss about this if you like.
Okay, so we have a few minutes to cover our last and quite important trend, which is obviously sustainability. I don't really need to throw at you COVID, social inequalities, energy crisis, climate. I think this EPEM is very special because I'm sure we have all in our heart experienced, the catastrophic climate event through the year. So tell us about, how you see private markets seriously getting involved and feeling, responsible for how the world will change. Who wants to start?
You want me to go? Yeah, sure. I'll answer it through a real estate lens, which is my investing role. The real estate industry is, I think it's produces 40% of carbon emissions, uses 30% of the world's energy. It has to change, and it can. The real estate industry can really have an impact on this problem. And I think one of the outcomes of this is you'll see huge value dispersion between assets, or in real estate, assets in the corporate world, companies or assets which have a sustainable future will prevail. Those that don't will fail. And I think this is sort of decades long. I think the value transition will be enormous. And I think it's a must-do thing.
Johnny, I started the introduction by saying that was very much at the beginning of you building the platform. Do you want to say something?
Yeah, we have funds doing, call it impact, call it ESG, call it intentionality, whatever. We have some of them are at vintage 4 and 5. Believe me, at 10 or 15 years down the road, we were not invited to conferences like these. But what I would like to say is the following. We hear a lot about ESG, and once again, sorry for being a bit provocative, in a mode of ticking boxes. We did our homework, we didn't harm. It's not about not avoid harming. Guys, what we've said about the current situation between equity and fixed income, so all what we've learned at university is challenged. Why? Because we're in a situation where we need to act. So it's very important today to benefit from this 1.4 trillion of dry powder to do things differently. We need to act with intentionality. We need to start thinking about not maximizing IRR, but let's maximize MOIC. Maximizing IRR is pushing us for crime, to put more leverage, and to do things wrongfully. Sorry to say that, but the house is burning, we have cash, we have means. We need to change a bit our mindset and leverage on the skills of the men and women and do things differently. Let's build a proper infrastructure which makes us resilient. Let's revisit our stock of real estate and do it differently. Let's fight for our food security. Let's use technology, which is a fantastic enabler to offset this inflation that we're living with. Let's benefit all collectively on doing things rightfully in intentionality. Let's stop just saying that we're ticking boxes and we're not harming. Let's move from the short-term approach of maximizing IRR on the short term and saying, I won't be investing in Africa, while at the moment regionalization is very important. By saying, I won't do greenfield project because the risk-reward approach is different. But if you don't do it, my friend, the money you're making on the short term today, you won't be making it tomorrow. So let's stop as well categorizing the asset class, saying this is impact, this is not impact, which is not done with intentionality, and avoiding to harm should not be part of the asset class we're dealing with. No one would have dared 20 years ago to say, like, for compliance reasons, I don't take a client on board. But tomorrow, trust me, our kids will put us in a situation where we should not invest in a project that doesn't deliver intentionality and additionality to solve problems. That's what we should do collectively. I don't know. What can I share more?
Joanna, you have
I'm
1
just going to
minute.
try to end on a happy note and say that ESG integration has become table stakes in our industry, and because private equity firms are in control, by most part, of the assets they own, they're in a really good position to implement change. And yes, I've seen a lot more appetite from clients to invest in products and services that address pressing needs, climate and energy, for sure. But there's lots of companies out there that don't necessarily have a product or service that address a need, but can be massively improved from an ESG lens, using more green energy, reducing emissions for the unit of output they produce. So there's a lot that can be done, and I think the industry is adapting and is very much now starting to integrate these like ESG KPIs into the business plans, and frankly improve on those dimensions as well as economic indicators, because they realize these factors are actually highly correlated from a value creation point of view, and it's also in the best economic interest for these managers to do so. So I'm
Let's
quite
link their
more
carried
positive on that.
interest to those KPIs of impact, and then the work can be achieved.
I think we have exceeded our time. Joanna, Johnny, Jim, thank you so much.
Thank you.